You know that feeling when it seems like there's just an endless list of things supposed to make you a better investor?
Oh, absolutely. New factors, new strategies popping up all the time.
Yeah, and it makes you wonder how many of these are genuinely insightful.
And how many are just, well, getting lucky?
Exactly.
That's really the core of what we're digging into today. Finance research is kind of awash with proposed factors.
Hundreds of them, apparently.
Hundreds, yeah. And they all claim to explain stock returns. So our task here is exploring a new method that tries to, you know, cut through that noise.
Separate the real signal from the lucky ones.
Precisely. Identify factors that are truly reliable.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so in this deep dive, we're looking at a research paper, right? Presenting a fresh way to identify these reliable factors.
That's the plan.
We want to get under the hood of their strategy, see what they found.
Understand the thinking behind it.
And, importantly, look at any potential drawbacks, too. Because the traditional ways, well, they have limits.
They really do, like giving different answers depending on how you slice the data.
Or being super sensitive to how you group stocks together.
Yeah, this new method tries to tackle those head on.
So what are the big challenges the paper points out?
Well, they highlight three key things. First, as you mentioned, whether you analyze returns over time, like time series, or compare different stocks at one point in time cross-sectional analysis. You often end up with different factors looking important.
Like the example they give.
Yeah, the market factor. Overall market performance, it often looks like a huge driver in time series.
Seems obvious.
But then, when you look cross-sectionally, like which specific stocks are doing better right now,
It's less clear.
it often fails those tests or seems less significant.
Huh. That does feel a bit counterintuitive, doesn't it?
It does. The second issue is how much results depend on portfolio formation.
How you group the stocks for testing.
Exactly. The paper notes that factors like size small caps versus large caps or value cheap versus expensive stocks.
The famous ones.
Right. They might look really strong if you specifically sort stocks by size and value.
Makes sense.
But if you grouped stocks differently, say by industry,
Those same factors might not pop out.
they might not seem nearly as significant. It raises the question, is the test creating the result?
So the way we organize the data could be like artificially boosting some factors.
That's the concern. And the third big point, maybe the biggest, the sheer number of factors proposed. Hundreds. When you test that many ideas.
Some are bound to look good just by chance.
Precisely. The lucky factor problem. You find statistical significance just randomly.
Yeah.
We need a way to account for that.
Okay, so these are some tricky issues. How does this new method try to get around them?
So the researchers developed this step-by-step model selection method using something called panel regression factor tests. It looks at stocks over time and across stocks simultaneously.
Okay, panel regressions.
And while they say it can be adapted for other frameworks, that's their main focus. The core idea uses a clever bootstrap technique.
Bootstrap. Sounds technical. What's it doing?
Think of it like creating lots of simulated versions of the real market data.
Okay, fake data based on the real data.
Right. But in these simulations, they specifically force the new factor they're testing to have zero real effect across different stocks.
So they assume it doesn't work in the simulations.
Exactly. They enforce the null hypothesis, as they say. Then they see how often, even under that condition, the factor still looks statistically significant just by pure chance in those simulations.
Ah, so it tells them how high the hurdle should be in the real data.
Precisely. It's a much tougher benchmark. It's a way to control for that multiple testing, that lucky factor problem.
That sounds like a much more skeptical and maybe robust way to test factors. What about the other issues? Time series versus cross-section and relying on portfolios.
Right. This is where their approach gets really interesting. They apply the method directly to individual stock returns. And their simulations suggest this doesn't actually hurt the statistical power of the test.
So you don't lose anything by avoiding portfolios.
Apparently not. And you gain something important. You sidestep the whole issue of how you form those portfolios potentially biasing the results.
Because the choice of how to group them is arbitrary in a way.
It can be, yeah.
Yeah.
And by using panel regressions, they're looking at both the time dimension and the cross-stock dimension together. They argue this handles the unique quirks of individual stocks better than just looking cross-sectionally.
Okay, let's dive into the strategy specifics then. How do they actually measure if adding a factor helps?
They use these panel regression models, linking individual stock excess returns to common factors. The goal is selecting factors that explain both the time trends and the cross-sectional differences.
And the measurement.
They use specific stats, simu and simadu, for equal weighting.
Equal weight, meaning every stock counts the same.
Right. An evaluated version, too, where bigger companies have more impact. These stats basically measure the percentage drop in the average or median unexplained part of stock returns when you add a new factor.
The intercept in the regression.
Exactly. But it's a scaled intercept. They adjust it based on the volatility of each stock's returns.
Why do they scale it? Why adjust for volatility?
Well, think about it. If you have a really stable, low volatility stock and your model misses its return by a certain amount,
That seems like a bigger failure of the model.
right, than missing by the same amount for a super volatile stock where big swings are normal.
Okay, makes sense.
So scaling the intercept by the stock's prediction error volatility gives more weight to those more meaningful mispricings. It helps pinpoint factors that genuinely reduce the stuff the model can't explain.
Got it. And how does this compare to something like the GRS test? That's pretty standard, right?
It is. But the GRS test asks a very strict question. Is the model perfect? Are all the unexplained parts simultaneously zero?
Which probably never happens in reality.
Almost never. The paper argues GRS tends to reject basically any model you try. Their test is different, it asks. Does adding this new factor make our existing model, even if imperfect, better?
A more practical question.
Yeah, more about incremental improvement. Plus, GRS can have issues when you have way more stocks than time periods, which happens with individual stock data.
And the bootstrapping comes back in here.
Absolutely. That bootstrap process generates the expected range for their test statistic if the new factor had no real cross-sectional explanatory power.
The simulated no-effect world.
Exactly. Then they compare the statistic from the real data to that simulated range. If the real result is way outside what you'd expect by chance,
Then the factor looks genuinely useful.
then you can be more confident it's adding value, likely beyond just luck. It also helps make the results less sensitive to things like limited data or returns not being perfectly normally distributed.
Okay, this sounds pretty thorough. Let's talk results. What did they actually find when they ran this on real market data?
Okay, so they used monthly U.S. stock returns, a long period, 68 to 2012, and it started with 14 prominent factors: market size, value momentum, and others. First, under equal weighting, every stock counting the same.
What popped out?
Well, no big surprise. The market factor, MHET, was consistently number one. It reduced that median scaled intercept by about 20%.
Significant. What next?
FIs, small minus big, came next. Smaller impact, around 6% reduction relative to just the market model, but still statistically significant.
Okay, market then size.
Then came value, book to market. That added about another 4% reduction.
So market size value sounds familiar.
Very familiar. It basically points to the Fama-French three-factor model. Interestingly, after those three, none of the other 11 factors they tested added significant explanatory power under equal weighting.
Really? None of the others mattered.
Not according to their tests and this specific methodology, no. And they noted that even with these three, the overall reduction in the unexplained variation was somewhat modest, around 28% total.
Okay. What about value weighting? Giving bigger companies more influence. Did that change things?
Big time. The market factor was again highly significant, but its impact was much larger, reducing the value-weighted scaled intercept by nearly 45%.
Wow, much bigger effect.
Yeah. And the next factor, not size or value this time, it was QMJ, quality minus junk.
Quality minus junk, what's that capture?
It represents a broader profitability theme. Think companies with stable earnings, good growth, that sort of thing. QMJ added another roughly 15% reduction on top of the market.
So market and profitability were the big two undervalue ring. Anything else?
The next best was BAB, betting against beta, but its incremental contribution was much smaller, only about 2.6%. So the final model they landed on for value weighting was really just market plus QMJ.
Market and quality profitability.
And the overall reduction in the unexplained intercept was much higher here, over 50% compared to the equal weighted case.
That's a really striking difference. How you weight the stocks completely changes the picture after the market factor.
It really does. It suggests the economic importance of factors might differ depending on whether you're focusing on mispricing across all stocks equally or focusing on where the bulk of the market cap is.
That's a key takeaway right there. Did they test even more factors?
They did. They expanded the set to 56 factors later, including many newer ones, but they found their core conclusions about the significance of the original factors didn't really change much.
Okay, so let's shift to the why. What's the underlying theory making this approach potentially better?
Well, it circles back to those initial challenges. The bootstrap, enforcing that no-effect idea in the simulations.
Right.
That directly tackles the lucky factor problem, the multiple testing issue. It sets a statistically sound bar for significance.
Controls for finding things just by chance.
Exactly. And using individual stocks instead of portfolios. That's designed to avoid the bias that might come from grouping stocks in a particular way.
The portfolio formation problem.
Right. Some research suggests that portfolio sorts can sometimes make factors look good, simply because the factor is built using the same characteristics used for sorting. Using individual stocks avoids that potential circularity.
And why panel regressions specifically for individual stocks?
Their argument is that panel regressions handle the unique characteristics, the idiosyncrasies of individual stocks better.
Things affecting just one company.
Yeah. The model allows each stock to have its own baseline intercept, soaking up some of that company-specific noise. This stops extreme movements in one or two stocks from distorting the picture, which can be a risk in purely cross-sectional analysis.
Makes sense. More robust to outliers.
That's the idea. And their simulations suggest this approach still has good power to find true factors. Comparing well against traditional methods like sorting stocks by beta, they argue you don't necessarily lose power by using individual stocks here.
It sounds like a solid approach, addressing key weaknesses, but nothing's perfect. What are the potential downsides or caveats we need to keep in mind?
Definitely a few important ones. First, they're upfront that the choice of framework panel versus cross-sectional regression can still matter.
Even with all the adjustments.
Yes. Their preference for panel regressions stems from worries about influential outliers and potential model misspecification messing up cross-sectional results. But it is a choice with consequences.
So the fundamental setup still influences the outcome. What else?
They really stress the importance of fixing your list of candidate factors before you start testing. Pre-specification, they call it.
Don't go fishing.
Exactly. If you keep adding factors based on what you see in early results, you just reintroduce the multiple testing problem through the back door. You need to decide the pool of factors up front.
Makes sense. Set the hypothesis first.
Right. Another big one is the backtesting issue, especially for newer factors like QMJ, that profitability factor.
The one that showed up in the value-weighted results.
Yeah. While it looks significant in their historical data analysis.
It was discovered relatively recently.
Exactly. It gained prominence kind of late in their sample period. Is its historical success genuine, or partly because we only looked for it after knowing it worked in later data?
Hindsight bias, basically.
Sort of, yeah. They contrast this with factors like market, size, and value, which have been studied for much, much longer.
So established factors might inspire more confidence.
Arguably, yes. And one final point. Their main analysis assumes factor loadings. A stock's sensitivity to a factor are constant over time.
Which might not be realistic.
Probably not perfectly realistic, no. Sensitivities can change. They do acknowledge this and point to their online appendix and other research for ways to handle time-varying loadings, but the baseline model assumes constancy.
Okay, good to know the limitations. So let's try and wrap this up. What are the main takeaways from this deep dive?
Well, I think this research presents a really valuable, rigorous approach for trying to sort the wheat from the chaff in the factor zoo.
Cutting through the noise.
Yeah. It tackles those big challenges, lucky factors, test sensitivity head-on using that bootstrap method, and individual stocks in a panel framework.
Aiming for more robust results.
Right. And the findings. They reinforce the market factor's importance consistently. But beyond that, it gets nuanced.
Depending on weighting.
Exactly. Equal weighting points towards size and value, echoing Fama French, but value weighting elevates profitability, QMJ, instead.
So for everyone listening, this gives you a hopefully deeper feel for just how complex this research is.
Absolutely. And a look at a more sophisticated way to think about what really drives returns versus what might just be, statistical luck.
It also really highlights how the methods researchers choose shape the answers they find.
Definitely. The how matters just as much as the what.
So here's a final thought to chew on. Given these different results under equal versus value weighting, what does that suggest about where market inefficiencies might lie? Are they more prevalent among smaller stocks, perhaps? Or does the sheer economic weight of large cap mispricing captured by value weighting tell a different story?
That's a great question.
And what could that imply for how you think about the market or even your own investment approach?
Yeah, that really gets to the heart of what these factors mean in practice. And for anyone wanting even more detail, the paper's appendices go into time dependence, other regression types.
There's always more beneath the surface.
Always.